Everyone. Uh, Good morning or good afternoon, depending on which part of the world you are in. Welcome to this very interesting leadership discussion that we have, in the context of what we are having around all of us, particularly in the GCC and more specifically in Bahrain, where we have this very interesting discussion with leaders in the banking industry. My name is Ram. I'm a senior partner with 𝗧𝗵𝗲. 𝗧𝗵𝗲, as most of you know, is a Forbes-ranked global management consulting firm. And we've been operating in the Middle East and specifically in Bahrain for the last 25 plus years. And this particular platform is being hosted by 𝗧𝗵𝗲 and IBS Intelligence. As many of you know, IBS Intelligence is the most well-recognized financial services, technology, research, advisory, and publications firm. It's a part of the 𝗧𝗵𝗲 group, and 𝗧𝗵𝗲 and IBSI have been operating specifically in this space for a long time. And this discussion today is going to be extremely relevant, contextual, and make this a very focused discussion, right? Before we jump into the leadership forum, we have a short presentation to just set some context. So I'm going to jump straight into the presentation that all of us can see. We're talking about navigating uncertainties and what is a strategic bank playbook looking like. And as part of this conversation, we'll just get a perspective on what's happening around us, and then we'll zoom into Bahrain and what the way forward can hold for us, right? Now, if I just look at the last 25 to 35 years trend, you can see that there has been, and this what you're seeing here is the crude oil price. And you can actually see how things have actually moved over the years. And you can see the significant amount of fluctuation that you can see in the last 4 to 5 years, driven by COVID, and then we had the Russia-Ukraine conflict, and then we obviously are now dealing with the West Asia conflict. It's obviously having its own implications over the years. And what that also means is each of the sectors we're talking about, have its own implications, right? You can clearly see shipping and trade as an industry being one of the most affected. We're talking about the strait being closed, and there are conversations around that, and this impacting the freight volatility and insurance costs. Airspace restrictions have obviously had impact, with having an impact also on hospitality sector. We are talking about pharma inventory and the raw material cycles getting impacted, which obviously has its implications on healthcare industry. No travel or less travel also makes implications on food and retail, and also on rising living costs around the world. And from a medium to long term, we're also seeing impact that's happening on the construction and real estate, which is particularly an important industry in the Middle Eastern context, right? Now, if I zoomed a little further on what this means, for different segments of a bank, the opportunities obviously are different, and the challenges are different, right? SME banking, we are talking about cash flow pressures that clients have, which has implications for anybody in the SME banking space. Trade corridor dependent businesses obviously have an impact on the fee income if you're a corporate bank. Spending patterns and rebalances and affecting your cards, auto loans and mortgages have an implication on retail bankers. Shift in the wealth into other regions will have its implication on wealth managers. Treasury obviously has an implication on liquidity and valuations. And even small finance and community lending have challenges on early stage repayments and what that means from a recovery, right? So the point is that it's the impact that we're talking about is not necessarily driven only with one industry. It cuts across industries, and as a bank, it actually has different implications depending on the profile of which kind of a bank or which kind of a banking you're focused on. Now, if I take a look quickly into the Bahrain context, just to set some macroeconomic context. I mean, over the last 10 years, the GDP of the country has grown at a CAGR of about 4%. The GDP per capita has grown roughly at 2%, which also means that the population has also been growing. But more importantly, if one looks at the contribution to the GDP, unlike some of the other GCC countries, oil contribution is not significant. The largest obviously coming from finance and insurance, followed by manufacturing, and then you also have other sectors contributing, right? So one of the important aspects here is about financial services implication, because we are in a panel discussion with bankers. But it's important to also get that context here in terms of what the Vision 2030 of Bahrain is, and which is clearly moving into a diversified private sector economy, and the fact that we have different implications across industries here, right? We just thought, just to set some context of how Bahrain stacks up against the peers in the GCC and also globally. The one thing that stands out in a Bahraini context is the banking asset to GDP ratio generally operates between 1 and 2, in most other regions. But Bahrain tends to have a slightly higher number, which also goes back to the profile of the industry, being the banking industry being one of the largest in Bahrain. And we are talking about a good sizable contribution of SMEs to the GDP contribution. Just gives us a sense on how Bahrain is against the comparative GCC countries. One of the very important and interesting aspect about Bahrain is the digital banking adoption. In fact, one of the highest in the world. Very high mobile penetration, a very high number of fintech players in the region. And we are talking about a significant growth in the digital payments, in the Bahraini context. All of these obviously have implications also for what we are seeing. And the government has also been driving a lot of, the regulator has also been helping driving, what could be policy level landscape reshape, be it open banking, be it digital payments. We just saw it in the previous page on how that's growing. Tokenization, which is helping with digital asset integration, encouraging fintechs to participate through regulatory sandboxes, embedded lending or digital credit, and a fair high degree of AI and data analytics, right? So we do see a lot of context here, because in a situation like this, it's not just about customers walking into the branch, but we are talking about a lot of digital transactions. And it's, if you remind of what we saw during COVID, we are talking about how engagement with customers doesn't necessarily have to be, in physical, but if you have the right kind of ability to engage with customers very closely digitally, that's going to be a critical success factor as well, right? So just at the context. Quickly, I'll talk about what the implications for banks in general are, and then we'll talk about a lot of these in the panel. As we navigate these uncertainties, there are about 10 key imperatives that are critical for us to look at. The first obviously is about liquidity and having the right visibility on funding and the concentration of deposits. Making sure that we have the right monitoring of the sectors across different trade activities, different sectors and macro signals. Making sure that we have the right credit tightening in a disciplined approach, where it is not a blanket retrenchment across portfolio, but we are able to be more zoomed in and focused. Having the right digital infrastructure. This is extremely critical, when you are actually dealing with, particularly on having the right BCP and DR. So having the right kind of stress tested and backup protocols. Engaging at a leadership level and building institutional trust. I think this is again a critical factor. Managing your foreign exchange and treasury desk very actively in terms of currency movements. Tracking early signals between 30 to 60-day delinquencies, and particularly when you're dealing with SMEs and also with corporates and retail. Having the right continuity from a business continuity standpoint, operational capacity, and having the right kind of institutional stability. Engaging proactively and consistently with customers and keeping the confidence reinforced. And lastly, obviously having the right kind of portfolio hygiene calibrated, right? So these are, 10 key imperatives that we actually at Cedar IBSI believe are critical to build the right kind of resilience. And that's just to set the context, for everybody to know where we are coming from when we get into this panel. So with that brief introduction, if I may request our panelists to join us in this discussion. Ladies and gentlemen, please do welcome the panelists here. We have Mr. 𝗧𝗵𝗲. He is the Chief Executive Officer at MENA Industrial Bank. Thank you, 𝗧𝗵𝗲, for joining us today.
Thank you. Thank you for having me.
I have my second panelist, Simone. Simone is the Group Chief Corporate and Business Development Officer at BBK, Bank of Bahrain and Kuwait. Simone, a very warm welcome to you on the panel.
Thank you. Thank you.
And we have our third panelist, someone who is in the Bahrain circles would know very well, Wafa Hameed. She heads the strategy function at Gulf International Bank. Thank you, Wafa, for joining us in this panel today.
Thank you. The pleasure is mine.
Before I jump into the panel and before I start posing any question to the panelists, I do want to mention that, it's very interesting that, if one looks at this panel, we actually have three different banks, coming with very different, orientation, if I may say that. And more importantly, leaders who also wear three different hats. And we have 𝗧𝗵𝗲, who's the CEO of the bank, Simone, who's heading the corporate and business development at BBK, and then we have Wafa, who heads strategy. So, I couldn't have asked for a more diverse and inclusive panel, if I can say that. And I'm very, very keen to actually listen to what they have to say, just as I'm sure most of us in the audience are, right? So with that brief background, 𝗧𝗵𝗲, I'm going to start this panel with a question to you, if I may. Now, obviously, we have seen what we have done. And if I was to ask you, how do you view the immediate risks that banks face today? And how do you see the need, and how do you see the banks making sure that they're supporting their clients, even as they continue to strengthen, what would be their own risk posture, right? I mean, how do you balance this, and how do you see the immediate risk that needs to be looked at as a CEO of a bank?
Thank you. Thank you so much, Vikram. Please allow me to first thank the organizer, the moderator, yourself, and other respected panelists, both Simone and Wafa, for having me in this important and interesting forum. Thank you very much. Your question is indeed a very important and relevant subject, particularly in the context of today's evolving regional and global environment. There are two parts to your question, and I will address the first part, which relates to risk first. Now, from a banking perspective, the risks the banking industry is observing today are, I would say, best described as globally interconnected. So, so that we start with the right context to avoid any misperception or misconception, I wish to start by saying that, from a GCC perspective, despite the geopolitical challenges, the banking sector remains fundamentally strong, supported by robust and capital adequacy, healthy liquidity buffers, well-established regulatory framework, and highly credible central banks. That said, there are several immediate risk dimensions that banks regionally and globally, especially in the GCC, need to actively observe and manage. In my opinion, the first risk, and you've mentioned it in your presentation as well, very clearly, is liquidity and funding stability, maintaining liquidity and funding stability. In this period of geopolitical and market uncertainty, market confidence remains a key transmission channel. So as a result, maintaining robust liquidity positions and diversified funding bases continues to be the first line of defense. Secondly, is microeconomic volatility. That's the second risk for me. This is because global growth dynamics, inflation trends, interest rate expectations, for example, and commodity price movements are increasingly interlinked. So these dynamics directly influence business confidence, investment appetite, and overall banking activity across regions, including the GCC. The third is credit risk, which we all know would typically emerge with a bit of a lag. So this is more evident if we look at leveraged corporates, which tend to be more sensitive to supply chain disruptions, cost inflation, and demand fluctuations. At this point, while we are not seeing extreme systemic risk or stress, there is a clear need for enhanced monitoring, early warning indicators, and proactive portfolio management. The fourth dimension within risk is market risk, particularly volatility in interest rates, for example, asset valuations, capital market activity, and credit spreads. In a globally interconnected system, as I mentioned earlier, repricing can be rapid, for example, and often asymmetric, which requires continuous risk calibration and active balance sheet management. The fifth risk is competitive risk. In a more volatile environment, competition for high quality assets, deposits, and client relationships tends to intensify. For example, clients become more selective, margins can come under pressure, and differentiation becomes increasingly important. Banks that are able to combine stability with agility and client responsiveness are the ones that will strengthen their market position during this period especially. Finally, we must not discount operational and cyber risks. And you've also mentioned this in your presentation, which has become increasingly relevant globally as financial systems become more digital and globally interconnected. The potential impact of operational disruption or cyber events has increased tremendously. Now, however, since our domain is GCC, it is equally important to emphasize again that the banking system benefits from a strong regulatory oversight and highly credible central banks. So authorities have both the experience, and we've seen it during COVID, and now it's tested again, the experience and the policy tools to maintain financial stability, including liquidity, support mechanisms, and where appropriate, targeted and temporary prudential flexibility to ensure continued credit flow to the real economy. Now, coming to the second part of your question, the key challenge is for banks to continue supporting clients while strengthening their own risk posture. So in my view, this rests on three core principles, which is prudency, early engagement, and disciplined execution. So three areas, prudency, early engagement, and disciplined execution. So firstly, banks must adopt a client-centric approach because the impact of global uncertainty is not uniform across sectors or geographies.
Correct.
Secondly, early engagement is critical. One of the clearest lessons from previous global cycles, whether COVID, the 2008 financial crisis, is that proactive intervention consistently delivers better outcomes than reactive responses.
Correct.
So thirdly, pricing discipline and risk differentiation are essential. So in an environment of elevated global uncertainty, risk cannot be treated uniformly. It must be carefully assessed. It must be clearly differentiated and also appropriately priced. So however, this should be implemented in a measured way, avoiding abrupt tightening, for example, and that could not unnecessarily constrain credit creation or economic activity. So in short, I believe banks that will navigate successfully are those that remain close to their clients, act early in identifying risks, and maintain a disciplined but supportive risk posture.
Very interesting. Very interesting, Shamzani. So you're talking about stay close, stay engaged, and be disciplined. I think that
Absolutely.
was a very interesting way to put it. And in fact, that's exactly what I'm going to take as a question to you, Wafa, right? And when we, as a strategist, when banks are rethinking strategy, how would you actually, prioritize between your growth and market exposure, and building partnerships, and how do you stay resilient, right? In a prolonged period of uncertainty. I mean, how do you prioritize where you actually would be focusing on? Wafa.
Thank you. I think let me start off by thanking you and the wider CDR team and our panelists and my fellow panelists and the attendees for taking the time to be here today. I think when you look at strategy, the honest starting point is acknowledging, to the point made earlier, that the environment and the context that we're living in today is different. So the context that shapes strategies and assumptions about where we want to grow, about how much risk we should carry, about what partnerships to invest in, all of that has shifted. So the banks that are doing the work today, seriously, they're making some quite deliberate shifts when it comes to looking at their strategies. If I address the 3 dimensions in your question, I'll tell you what I'm observing on each. So on growth, I think the most significant shift that I'm seeing is a move away from broad market coverage towards much more deliberate focus. So in a benign market environment, you can grow by doing more of everything. You can have more products, you can go into new markets, you can expand client coverage. The returns on that incremental growth are reasonable, and the cost of being spread thin is manageable. That now changes. So I think the more resilient banks are making choices about where they genuinely have a competitive edge, whether that's by sector, whether it's by geography, by client segment, and they're concentrating their resources there. Equally, they're actually being more honest about where they don't have a differentiated position, and there they may be reducing exposure, even if that means walking away from short-term revenues. That discipline, it's actually genuinely difficult to execute because it requires conviction when you're faced with short-term pressure. But the alternative, which is trying to defend a broad, undifferentiated position in markets where clients themselves are making harder choices about their banking relationships, is increasingly difficult. There's also an important point about where the growth opportunities are emerging. So as 𝗬𝗵𝗄 mentioned earlier, the effects of this uncertainty, they're not distributed evenly. There are sectors and geographies where the tailwinds remain strong and where, even if in the near term the pace is uncertain, the long-term direction of travel is clear. So the banks that identify those pockets early and they build the depth there, rather than waiting for the environment to stabilize, I think those are the ones that I'd expect to emerge with a stronger franchise. Moving on to market exposure, here I think the thinking is probably the most nuanced because it sits between strategy and risk management. It's not just strategy. So the traditional response to uncertainty is, as mentioned before, reduce exposure, tighten credit, pull back from markets that feel less certain, wait for clarity. There's logic in that because balance sheet discipline does matter in a volatile environment. In my view, the more appropriate response is to be selective rather than broadly defensive. And the banks that are managing this well are those that are differentiating between the clients or the sectors that are cyclically stressed and those with structural problems. So they're looking at markets where they have genuine expertise and those where they're just carrying exposure. They're also reducing the concentration where the risk return doesn't hold up for them and leaning more towards where they have a competitive edge. Another dynamic that is worth noting on the opportunity side, we've seen global institutions becoming much more selective about balance sheet deployment. They've been pulling back from non-core markets. So this has created a space where if you're a well-positioned player, you can play, and sometimes in a meaningful way. I'm a massive believer in client centricity, and I really think that our clients are asking harder questions about relationship continuity. The banks that demonstrate that to their clients that they will be there for them during a difficult cycle and not just when conditions are good or easy, these banks can build a different quality of relationships. That's a competitive dynamic that I think is worth being deliberate about and capturing. Moving on to partnerships, the thinking on partnerships has genuinely evolved, and I think for good reason. Traditionally, the instinct was build everything in-house, own the full value chain, compete on product breadth. In the current environment, that's harder to sustain. Technology cycles are faster, capital is more expensive, and the range of capabilities that clients expect has expanded. So I think banks are being much more explicit about what they do best. They're investing seriously in those capabilities, and they're accessing other things through partnerships. That could mean partnering with fintechs on distribution or on client experience. It could mean working with alternative capital providers to offer financing solutions without actually having the full balance sheet consumption of a traditional lending model. A good example of this is the originate to distribute model. It allows banks, especially like us, to serve clients at scale while we manage our capital position much more dynamically. The nuance with the partnerships is I think they only really work if they're grounded in genuine logic. So those partnerships that are built around a short-term opportunity, they rarely create lasting value. The durable partnerships are those where each party brings something to the table and they are genuinely complementary. So there's a shared long-term interest in the outcome rather than just in the next transaction or in the next deal.
And you would say that applies in general and also in the current context, Wafa?
Yes. I would say that's for both. If I put all those three aspects together, so what connects growth, focus, market exposure, and partnership, it's really the same underlying discipline. It's being deliberate about where you have advantage and focusing there. The uncertainty makes that harder. To the question you just asked, it does make it harder because it raises the stakes, right, on every decision. But in my opinion, it makes it more necessary. Because if you use this period of uncertainty to sharpen your positioning rather than defend your position, those are the banks that I think will emerge from the uncertainty with a genuinely stronger competitive position.
You said something very interesting, Wafa. You said that banks have to be sharpening their focus, and that's the need of the hour. And that's exactly what I'm going to take as a question to Simone, my other panelist. We are talking about uncertain periods here, Simone, but we also see that banks have to obviously be tapping into, as Wafa calls out, sharpened, focused opportunities, right? So if I was to ask you, I mean, as the customer, how do you see the customer needs evolving or changing in the current context, A? And B, in that context, where do you see opportunities, particularly given the uncertain times that we are in? Simone.
So thank you very much, and thank you to the 𝗧𝗵𝗃 team and to the other panelists. The problem to be the last one when you have knowledgeable speakers before you is that probably most of it has already been said. But let's start with your analysis, right? The IBS analysis. I couldn't agree more, right? You summarize it. So what you summarized is what we also believe. And if you look at dynamic, like we were talking, right, that we are different banks and we have different objectives. And we are going through the retail up to government and institutions, so, and everything in between. And if you're looking at the behavior of one segment to the other, and within the segment, right, retail goes from, different levels up to priority. Private banking goes from wealthy people up to ultra net worth individuals, and so on and so forth, right? So all of these segments within these have their own peculiarities and their own needs. But let's start to generalizing a little bit, right? Let's say that what we experience in COVID is also through a year. when this geopolitical evolution started, one of the things that I think even the central bank was scared of is the bank runs, right? Everybody goes to withdraw the money. Quite the opposite. We saw an increase in the client deposits, right? Because you are not in the mood of spending, so your discretionary and non-necessary items stop. Travel is not there. So instead of a run, we are fraught with liquidity at the moment, right? And but what that means, it means that on the other side, the corporate are not selling, right? Because the malls were empty, and you were totally right in your analysis. If you are taking the food, the long-term food that doesn't expire the next day is probably okay. But if you're going in a supermarket and you see those that are more, vegetables or those that are expiring, it's totally different, right?
Correct.
So on the one hand, you have flood of liquidity. On the other, you have, customers that have a disruption in the supply chain. Everybody talks about energy, but energy is one part of it, right? That is also the big. And so what that means, it means that, for example, in where's the opportunity is execution and capability, because your clients are coming to you and say, sorry, my general supplier is not there anymore. I have to change to a new supplier, but these new suppliers want a transferable LC. What's a transferable LC? I don't even know. They want a guarantee made on specific words. So all of this means that you need to have execution and capability if you want to take advantage of this opportunity. I will come to some of the opportunities that we see. But also, it depends on how you reach a moment of crisis, right? I have 31 years of experience, so I've been through, you name it. And sometimes when you reach a crisis, you have your liquidity messed up because you did an investment, just before the crisis. You have maybe your ratios that your CET1 or your CAR messed up. So what that happens in a moment of crisis is that the management and the board look inwards, right? You're not there for your clients because you need to sort out your mess. So the opportunity that I'm talking about and what I see is from BBK standpoint. Then, as I was saying, we are okay with liquidity. We are okay with all the ratios. So we really can concentrate on the clients, right? On the customers. So the first opportunity, I wouldn't agree more with Wafa. Everybody's good to serve the clients when everything is going fine and clients are overbanked and we are all good and go and cheering and having meetings. But now the clients are coming to you and say, sorry, there is a force majeure here. I can't pay you. What are you going to do? Or I need to delay this payment for 3 months. What are you going to do? Now, that is where if you have resilient and you are strong, then you can attend, right? And that is true for your main relationship, but even when you are second or third in the line, right? Because if you're lucky enough that the bank next to you or the first relationship bank maybe has one of those issues that I was discussing, so they are slowing the credit, slowing the financing, maybe recalling some of these overdraft, then you're there, and client will remember, right? So that I don't think I agree with Wafa. It's not an understatement. If you're there in a moment of crisis, clients will never forget. So that's the first opportunity. Second opportunity, as you were saying, your analysis. Well, you change the corridor of trades flows, you change currencies, you mentioned Forex. I don't here to say that now Swiss franc became as important as the dollar, but there is an increasing volume, right? And you need to be prepared to give competitive rates in those currencies that before were not probably in the GCC in the radar, right? And we saw an increase. Wafa was saying again, partnership, right? We partner with an investment bank, right? Because we wanted to get into this side of things. We didn't want to create all the team internally, so we create a partnership with an investment bank. I hate the expression, but they become our kitchen, and we are becoming the more the distribution and the client facing. Now, starting with has been going around for around 6 months. You know, it was good. We were meeting clients. Now we are fully booked for the next 2 weeks because clients have issues and have tactical issues. You know, how am I going to survive for the next 2 weeks? But if I do, I want not to be in the same position if this thing goes on for several months. And for sure, I don't want to be in the same position if it stops, but it happens again in 6 months, right? So there is a request for 2 things mainly, looking at balance sheet and really from a pure advisory. Is the balance sheet good? How can we make it different? How can we make the balance sheet more resilient, not just the working capital? And the other things, if you're going on the institutions, whether they are investors or not, but they want to diversify. So now we are busy with, you want to keep the liquidity where your main business is, but you don't want all the liquidity to be where your main business is, right? Especially when it is under threat. And so we have demand for deal flows, opportunities, investments in other markets. And obviously these were not so present, only 1 month ago, but now they are. We get questions, we get calls, and they want to see us. So if I had to summarize, I think, on the retail side, obviously you need to attend the liquidity. Us, for example, have strategies in campaign. Also, we like to portray that we are stable, we are funded, we are a national systemic bank, that we are, looked closely by our regulators, so there is no problem to banking with us and, transfer those deposits to us. And that is one of the opportunity. On the SME up to the corporate side, we are attending working capital whenever we can, but also, as I was saying, we are going into the advisory side, and for institutions, we are trying to also create a pipeline of opportunities to diversify in other markets.
Interesting. Well, very, very interesting, Simone. And I think as you rightly coined, I think when one is weathered by different situations in the past, then you obviously your instincts are natural in dealing with situations. And in some ways, I think COVID has also helped us to actually be dealing with some of these contexts, right? But I think there were a lot of convergence in the points that we had from all the 3 of you. So I'm going to actually take all 3 of you with the same question. And I'll pose it in a way where you can see this, and I'll maybe start with you, Wafa, and then I'll go to SHAMZANI and Simone with the same question. And the question is this: if you have to obviously be defining resilience, right, and defining resilient banking in this environment, and if you have to prioritize between risk discipline, I'm using some of your terminology there, SHAMZANI, risk discipline, strategic agility, and ability to staying very close to the customers, like what Simone said. And if you have these 3 in front of you, and you can choose a 4th if you like, Wafa, what would you pick as the most critical? I mean, obviously, we all know it's all of the above, but that's not the option that I'm giving to you. You have to, if you had to prioritize the most critical one of what I just said, what would you pick and why? And then I'll go to the other panelists.
Thank you. That is not an easy question. I think it'll be interesting to see the different views on this one. And I will not take you up on your offer to add a 4th dimension to it.
Okay.
So it's a very difficult question to answer, right? If you have risk discipline and you don't have strategic direction, you're paralyzed. You have a bank that's technically sound, but commercially irrelevant. If you have strategic agility, but you don't have risk discipline, you're reckless. So you will move fast in the wrong direction and you'll destroy shareholder capital. And staying close to customers is hugely valuable, but you also need the balance sheet resilience to deliver for them when it matters. So if I have to choose one, which you're making me, I think given my role, it's not going to come as a surprise. I would say strategic agility, but let me explain why, because I think it might not be the obvious answer. Every bank has risk frameworks. They do stress testing, they have capital buffers, they have regulatory thresholds to abide by, they have credit committees. So the infrastructure of risk management is well developed across our industry. It's necessary, but it doesn't necessarily differentiate you. So you can survive this period on the basis of risk discipline, but I wouldn't say you've won anything from it. You've just avoided losing. So you've survived rather than I wouldn't call it resilience. I would call it survival. I talked about staying close to the clients, and like I said, I think that's so important, and I don't want to diminish from it.
Yep.
But I also believe that client proximity on its own, without the strategic clarity to act on what you're hearing from your clients, if you don't do that, you don't have competitive advantage.
Fair point, Wafa. I mean, just so that we are being fair to the to the panelists. This is not to say they are the one you pick is the only factor and others are unimportant. I mean, we're just saying what would you find as the most critical priority focus area, right? I mean, this is keeping everything else equal. Yeah.
I think for me, it's strategic agility, to the ability to be able to read the shifting environment, to reposition. I think that's what's most important.
Very interesting. Very interesting.
And the banks that are genuinely resilient in this environment will be those ones that are making the clear choices and adjusting where the evidence tells them to.
Resilience is equal to agility in your definition. I like that, right? If I was to take that question to you, SHAMZANI.
Sorry, yeah. Well, I'm afraid I'm a slight contrarian here to Wafa's view. In my view, resilience in today's environment is not defined by a single capability, but rather it is defined by how effectively a bank can combine all the three disciplines without compromising any one of them. And let me explain, But if I were to rank what truly matters at bank leadership level, I would describe risk discipline as being the foundation, strategic agility as the accelerator, and customer proximity as the early warning system. Yeah, this is because a resilient bank starts with control of its balance sheet, strong underwriting standards, disciplined liquidity management, and consistency in risk appetite. Yeah. Additionally, strategic agility is what differentiates leaders from followers within the industry. This is due to the fact that the environment we operate in is shifting quickly. For example, rates, geopolitics, liquidity conditions, and competitive dynamics are all moving at the same time as we speak. So agility is what allows a bank to stay relevant while others become reactive. Right? Now, lastly, customer proximity. Now, customer proximity is what connects both risk and strategy to reality. In periods like this, especially, the earliest signals of stress or opportunity do not come from models or financial models. They come from clients, actually. So banks that are close to their customers understand pressures earlier, respond faster, and avoid surprises later. So equally, they are better positioned to support viable clients and deepen relationships when others step back, as per what both my esteemed panelists have mentioned. So if we bring all the three together, we can summarize that a resilient bank is not the one that is most conservative or the one that is most aggressive. It is the bank that is disciplined enough to protect itself, agile enough to adapt, and close enough to its clients to see change before it happens. So that's how I would describe it.
Very interesting. So you actually very nicely sequenced it, Shamzani. I mean, obviously, as I said, it is not one over the others. It is about what's the most prioritized area. And you actually coined it as risk being the foundation, agility being the accelerator, and staying close to the customer as your early signal. I think that's a very interesting perspective there. Thank you.
Yeah.
Thank you. Thank you for that. Simone, I always leave you with this hard task of speaking after your other fellow panelists have done. So your turn, sir.
And they are very good, so they leave me little to discuss. But hey, what to say? Risk discipline is important, not just in a moment of crisis, right? Across, every single cycle of the business. Strategic agility is the buzzword that came, around 10 years ago, and probably sometimes it's overused because we want to be all agile, and then it takes 3 weeks to approve a credit. So that is also, something that we need to define what we mean by agility. And customer proximity, we already said it. Is where we want to be, right? Obviously, to me and close to my heart is customer. We are customer obsessed in BBK. We have a new CEO that joined 1.5 years ago, and he came with this sentence, and he repeats this in every single meeting, every single week in the executive management meeting. He keeps saying we need to be customer obsessed. And he lives with it, because if you write an email, you might be, a retail, not just institutional, you are a retail, and you write an email to him. He copies half of the bank to sort out the problem, and he replies himself to, and it takes a lot of time and lots of pride to do it. So I for sure, if I don't want to be fired, I need to choose customer proximity. But I will add a fourth one, right? Nobody did, so hey, so at least I got something different to say. I will wrap it up, right? And as I was saying before, I think if you're lucky enough that you are reaching a moment of crisis with a strong balance sheet, and obviously with your ratio altogether, all in place, and your liquidity, I think capability and efficiency is my favorite, because clients at the moment, for once, and I handle trade finance, for example, for some time, and for once, they are not talking about pricing, right? They want fast execution, they want the right advice, and they want us to deliver. And if you are, charging 20 bips more, they're not going to be, and very, very vocal about it. So I think execution and capability at the moment is what my favorite one, notwithstanding that everything that we discuss is, obviously extremely important, I think, across all the business cycle, not just in a moment of crisis.
Very fascinating, Simone. I mean, I do have a couple of thoughts on what you just said. But before I went into that, I just want to let our audience know that we will take 1 or 2 questions for our panelists. So please feel free to put your question in the Q&A box that you can see on your screen, and then I will pick the ones that I could pose to our panelists. So while our audience is posing some questions, Simone, you said, you made 2. Incidentally, if I just looked across the 3, and I assure our audience that this was not a choreographed choice. You literally had the 3 panelists prioritizing very differently. We had Wafa saying agility, while everything else is also important. SHAMZANI actually talking about risk being foundation, and Simone, like the way you said, customer obsession being your mantra. And of course, you talked also about the execution capacity being another 4th dimension to add, right? But I actually want to maybe go back to that point you made, Simone, while we take another question from audience. You actually made a very startling statement that, look, in today's context, it's unless you're actually having 20 bips higher than everybody else, people are not or let's say less sensitive about pricing on the one hand. And you also made another, very, very strong statement that how do we define agility if you're going to take 4 weeks to approve a loan, right? And that's where the whole execution, excellence and execution capability comes in play. If you were to actually, and if you were, let's say, a customer of a bank, and you have to actually, express yourself on what you would expect your bank to do, how would you express it, Simone?
No, clearly, the customers are customers, right? And we have different customers, as we were saying, from retail to, SMEs and corporate institutions and governments, and all have different, priorities and different objectives. But there is some fundamental underlying, right? And the customer want to be served, as fast as possible, as with quality. And today's, with digital capabilities, right? More and more, we see that the branches are less busy and the digital is becoming, So how do I define what a customer wants? Well, I'm a customer of banks too, right? Obviously, my first bank is BBK, but I'm also using, I have to say this, but it's also true, right? We are obliged to bank. But I'm also, for investment, for example, I'm using also others. And what do I want? I want quick advice, and I get restless if it takes for them to come back to me, right? So agility, I don't discuss, is very, very important, right? But it's the definition of it that makes the difference. What we try to do in BBK for putting some life to this word that everybody is using, we are giving KPIs. And I think a few years ago, there were unrealistic KPIs. So you're going from taking 4 weeks and you want, to approve a credit, and you want by the end of the year it takes 1 day, right? Then it didn't happen, right? But now we are putting stages, and we are defining what agility means in the long term, so the good end in mind, but we are staging it in what it means in the shorter term, right? So if there is an improvement and we are going towards our client obsession, then it's good. If we are derailed and we are going back, it's very bad. And we are impacted on our internal performance, our KPIs, and so on and so forth. So
got it.
That is my answer for agility. And
very nice. There is a question from one of the audience, Shamzani, and I'll take this to you. How much does digital influence the proximity to customers? And is there a view that you would like to add there?
Yeah, well, I'm audible there. Okay, so I would say it's massive. Because especially if you look at the GCC, digital is paramount. Now the question is, that a lot of industry players would have to figure out is it massively fully digital, or is digital the leverage? So that is actually an answer which bank to bank, different banks would have a different model or would have a different strategy to go about. And the other thing that needs to be considered as well is how much investments do you put into digital vis-a-vis what you're trying to do with your strategy. So so you need to think about what is your model and what is your strategy, and where is your market, who are your customers. So it's not one strategy that works for everyone. So
Right.
Digital comes in with a more customized and I would say segmented strategy from bank to bank.
Got it. And clearly it's not about one size fits all. You have to make sure that you're focused and zoomed in. Yeah. I think that brings us to the curtains to be drawn on this panel. If I may actually take a moment to thank you, all the panelists for very, very engaged and extremely enlightening thoughts. I have to mention that, the personas obviously helped in actually also seeing things from very different views. And thank you again for your time. I really appreciate this. And on behalf of our audience and CEDAR and IBS Intelligence, a big round of applause and thank you for your participation.
No,
Thank
thank you. Thank you for having us. Thank you.
Thank you so much.
Thank you. Thank you. Have a nice day.